All right, so let's talk about 216B here. Here, what they're going to look at, we really just want to learn that allocation of unearned revenue over a period of time, as opposed to a specific point in time. We're going to talk about earning revenue over a period of time. We touched on it a little bit in 15B, talking about that $36,000 retainer, right? That was the start of the whole problem. Well, here they're just going to say, hey, accepted $120,000 cash as an advance payment for managing financial assets. So that's always going to be important when you see advance payment in advance for services to be performed in the future. That kind of verbiage should let you know, hey, we're going to be dealing with an unearned revenue here. Okay, so the first thing they want us to do, as always, is just take a look through this and talk about how does it impact our horizontal statements model. Again, got the balance sheet all the way to the left here, then your income statement, then your statement of cash flows. So just looking at how one transaction can affect all of those. So not that all of them will, but some of them definitely are going to. So the first thing we got to decide is, the favorite thing that I like to do is I like to look up here and I look at my dates and I look at how much and how long the contract's for. Contract's for a year. Okay, he takes the contract in May for $120,000. So in year one, he's going to have that contract for May, June, July, August, September, October, November, and December. 8 months. So what we need to figure out is in year one, right, we're going to take that $120,000. Okay, we're going to multiply it times 8 over 12, which, as we know, turns into 960, so 120 times 8 is 960 over 12. Okay, so how much revenue are we going to recognize over the course of that first year? 80. Now, of course, I did this in thousands, so we need to take this, multiply it times 1,000. This tells us that it's $80,000 in year one. So now we can go through, start filling out our problem here. So in transaction one, we accepted $120,000 in cash. Okay, that becomes unearned revenue. We've done nothing to earn that, to earn the right to call it revenue yet, so it's sitting in that liability account called unearned revenue. Also, since we've not earned it or claimed it as revenue, there is no revenue, there is no expense, meaning there is yet or not yet any net income, right? But we do have a $120,000 inflow of cash for operating activities. The service we provide is financial management. That's what we're doing here, so it goes under operating activities. For number two, okay, what happens next? Well, we're trying to figure out how much revenue we're going to recognize in year one. Well, that's easy. We already figured that out, right? There is no more cash, okay? But we are going to recognize that we have to reduce the unearned revenue by 80,000 because we earned 80,000 of that revenue. If you remember, excuse me, that's not correct. If you remember, right here, we earned 80,000 of that revenue, so that's what we're going to reduce this by. Okay, retained earnings increased. Why? Well, because revenue increased, which increases expenses, or excuse me, increases net income. There are no expenses to deal with. So we just have a net income of $80,000. Is there a cash flow here? No, no cash flow. Cash flow happened in transaction one, right? So our retained earnings also increased by $80,000. So here we can just go through, give our totals, $120,000 in cash, $40,000 remaining to collect in unearned revenue in year two, $80,000 increase to retained earnings, $80,000 increase to revenues, no increase to expenses, which means we have a increase in net income of $80,000, and we had a total net change in cash flows of $120,000 inflow of cash. So revenue that we're going to recognize in year two, well, that's simple. It's simply the unearned revenue that's left to collect. Okay, we have to collect $40,000 in year two. And then how much cash do we receive in year two from operating activities? And we won't receive any, right? He's already paid us the cash. She's already paid us the cash, $120,000. So in year two, as we recognize that revenue, we will not have any more cash flow. So that is 216B. If you have any questions, please feel free to contact me.